Is reversal trading the death of all traders' dreams to become consistent and profitable traders? Does reversal trading cause more wins than losses? Well, in today's video, we're going to discuss that and see if we can find the answer to pave the way for you moving forward to become a profitable trader. So the first thing we need to understand is, what is reversal trading? A reversal is a change in the direction of an asset's price. It can be positive or negative. When an uptrend loses momentum and the price of an asset starts to move downwards, it is the opposite of a continuation when an asset's price carries on moving in a certain trajectory. So reversal trading in its basic form is taking a trade in the opposite direction of a trend. When a trader perceives that price is pushing in an uptrend, but will fail to continue to make new highs and eventually will turn bearish, and vice versa. When a trader identifies that a trend is moving bearish, failing to make new lows, and then eventually will start pushing bullish. Now, the question is this really a bad thing? What is a falling knife? A falling knife is a colloquial term for a rapid drop in the price of value or a security. The term is commonly used in phrases like, don't try to catch a falling knife, which can be translated to mean, wait for the price to bottom out before buying it. Now, what about selling? As Rox likes to put it, would you jump in front of a moving train? Probably not. So the term jump in front of a moving train refers to the action of selling the markets in a clear uptrend with no evidence of a reversal in play. So do you like that? I was waiting for the day where I could have my own quote in one of my YouTube videos. But moving forward, the big question is reversal trading as attractive as it sounds, considering the terms falling knife or jump in front of a moving train? Is having a reversal mindset or looking for reversals as beneficial as it may sound? Most traders do it because they're looking for bigger risk reward ratio trades, or they may be doing it because they just think that if they get in at a better price, then guess what? They'll be first into the markets and they'll make the most profits. But before we move forward, there is something that we need to understand first regarding reversals. Reversals are sometimes hard to predict and to differentiate from short-term pullbacks, or so-called noise. While a reversal denotes a change in an asset's price trend, a pullback is a short-term counter movement within an existing trend. Reversals always start as potential pullbacks. The challenge is to spot whether it is only a pullback or the real thing, a full on-price reversal. Those traders who misidentify reversals for pullbacks and vice versa can therefore incur significant losses and miss out on potential profits, either by not sticking with a good thing or by not pulling out at the right time. So I think we found the problem here. A lot of traders misidentify what they believe to be a reversal in the market to an actual pullback in anticipation that the markets will then continue in the opposite direction of a trend, only later to find out that the trend is still in play, price pulls back to key levels, finds some sort of resistance or support, ends the exhaustion phase, and then what happens? The continuation starts. So why do traders constantly do this? Look for reversals in the market. As we've already seen, it's like looking at catching a falling knife or jump in front of a moving train. I don't have to outrun the bear. I just have to outrun you. If the bear gets one guy, he's not going to keep running to get the other. In life, it means that you don't need to be the best. You just need to be better. So I think most traders come into trading because, they really want to succeed at something in their lives. They maybe want to get out of their 9-to-5s. They want to support their family in other countries, or whatever the reason may be, which is understandable and at the same time also very relatable. But what happens in this scenario as they continue to trade, learn different strategies, and then unfortunately continue to lose money, bad habits start to kick in. Once these bad habits start to kick in, what happens is the trader then becomes like the person trying to outrun the bear as a person who outruns the person, meaning that the battle with trading becomes personal. They're constantly trying to beat the markets, trying to get first place, trying to get in the markets as soon as they can so that they can make bigger profits, bigger risk to rewards, and for whatever other reasons they may have. Now, of course, we know this is the wrong mindset, and we know ultimately at the end of the day, this is not what's going to provide you with the path that you need to become consistent and profitable. But why is this relevant to what we're talking about now in terms of reversal trading? We can't stop anticipation from happening. The human brain is always on and always working. Anticipation is rooted in the portion of the brain known as the cerebellum, which controls automatic non-thinking behavior. With this anticipation always in play, the human brain desires more dopamine. Dopamine is a chemical neurotransmitter. It's released from the brain's frontal lobe and acts as a stimulant that prevents pain, stimulates arousal, and causes excitement. Dopamine stimulation happens when we experience and expect good things. Anticipating positive events sustains the output of dopamine into the brain's chemical pathways. So just from reading that, we can see that humans are wired to succeed, to want to get good results. But what traders need to understand is that trading is completely different. There's no hierarchy. There's no accolade. There's no first place to be won. Scientific experiments show that most people anticipate future positive events as opposed to future negative events. In absence of anxious, depressive, psychological disorders, people automatically anticipate happiness more than they do sadness. So most traders come into the markets, and especially reversal traders, the topic that we're talking about today, come in anticipation that they'll be able to get first into the markets before anybody else. They'll be able to get smaller stop loss placements. They'll be able to get bigger risk to rewards, in turn make more money, and then eventually, I guess, share their trades on social media and or share with their friends. Now, this asks the question here, do traders who are reversal traders who have this mindset lose concept of the real reason why they're trading? I think for the best part, the answer is yes. And when the answer becomes yes, then ultimately everything that we do as a trader is a gamble. Now, personally, I think reversals is almost like a full sense of security. And I understand why traders do it. I personally have done it in the past, and I continue to work on it now. So I'm not saying that it's a bad thing, but I do think it's time that traders get to the stage where they realize trying to be first into the market or anticipating where they believe the market is going to turn around, as opposed to jumping in the market in the direction that the market is moving, you will find that you'll continually have ups and downs, ebbs and flows that probably swing more than they should do if you were just simply trading with the direction that the market was moving. It doesn't matter if you're an optimist or a pessimist. The brain is wired to anticipate positive experiences. If reversal traders constantly feel that they're invincible, that they can anticipate where the highest peak is or the lowest point is in the market and identify where the market's going to turn around, even though with the examples or analogies that we mentioned, the fall the knife or jump in front of a moving train is not enough for them, then what does that spell for that trader in the long run? Ultimately, it's going to lead to disaster. Now, I'm not saying that there are not reversal traders out there that do pretty well and make money, because they're able to be patient. They're able to be disciplined and wait for price to come back to most major areas in the market. I'm talking the highest points and the lowest points. But the problem is when you have a reversal mindset is you're constantly trying to identify any first signal you can get at intraday levels, intermediate levels, where price potentially will reverse, but ultimately will not, because it's in transit in either or direction. Many people try to become a hero and start investing capital against the dominant pattern in Forex. This idea may seem profitable, as we know that 90% of investors fail to make money. This inspires other investors to undertake strategies that are not commonly followed. They start overestimating themselves and use techniques that are dangerous and requires precision in the market. So for us to understand this in plain English, is it better for us to be the type of trader that constantly anticipates the market's turning of events? Or do you think it's better for us to be the trader that can identify clearly that the market is moving in an uptrend, or is bullish on the day, or is moving in a downtrend, or is bearish on the day? Well, personally, I can't give you an answer and say yes or no. It really depends on who you are as a trader, your appetite for risk, and of course, your strategy. But I think that it's clear to say that more often than not, when we identify an uptrend, the time that we waste on anticipating price reversing or identifying the best levels where price is going to bounce off of, we waste time eventually to come back to the charts later that day or the next day to see that the markets have continued in that direction. And I've seen many traders who have seen bearish candles on high time frames pushing bearish. And because they missed the bearish move or the bullish move, what do they decide to do? Instead of joining the movement, they decide to take the reversal and hit buy in a selling market, or sells in a buying market. And then eventually what happens? Price continues in that direction. And I think personally, if you're trading with a trend, you're not becoming that type of trader who's always anticipating where price is going to reverse from. There's a lot more peace to know that you are on the right side of the market than to hope that the market turns in your direction and then be on the right side of the market. So we know that majority of traders are unsuccessful, and the figure they mention is around 90%. Latest reports do reveal that the number is actually not correct, but we're not going to talk about that today. It is around 75 to around 85% of traders that don't succeed due to broker records. But that's not the debate we're having today. The question is reversal trading really worth it? And is it really sustainable in the long run? Well, I think the evidence that we've looked at today and some of the facts that we can incorporate into, the thoughts about reversal trading versus trading with the movement is strong enough to say that probably it is one of the main reasons why traders are not profitable and consistent. That doesn't mean that you can't use it. It just means that it's something that you need to think about if you're not getting the consistent and profitable results that you're looking for. But of course, that is just my opinion, and I want to get your opinion. So in the comments, let me know below, what do you think about reversal trading? Am I wrong? Is reversal trading actually as profitable as it may seem, or is trend trading the way to go? I hope you enjoyed this video. And if you did, make sure you hit that like button, subscribe if you're new to the channel. And of course, as I always say, continue to trust the process.